I've been thinking about something lately. I'm sitting here, and I'm 70 years old now, and I've spent most of my life watching people try to get rich in the stock market. Most of them failed, not because they were dumb, not because they didn't work hard, but because they were playing a different game than they thought they were. They think it's about picking the right stocks, timing the market perfectly, finding that next big thing. But it's not. It's about something much simpler and much harder. Let me tell you why 99% of Americans will never beat the stock market and why that might actually be okay. Let's start with the truth nobody likes. Most people don't actually want to invest. They want to gamble, but they call it investing. There's a difference, a big one. When I was a young man, maybe 11 or 12 years old, I bought my first stock, 6 shares of Citi Service Preferred, paid about $38 a share. And you know what happened? It dropped to $27. I was terrified. My older sister invested with me and I felt responsible. Every day I checked the price, heart pounding, thinking we'd lost everything. Then it bounced back to $40 and I sold feeling pretty smart. Then it went to $200. That taught me something I never forgot. I was so focused on the price, on the short-term movement, that I missed what the company was actually worth. I was gambling on numbers, not investing in value. And that's what most people do today. They watch screens, check their phones constantly, get excited when something goes up 5%, panic when it drops 3%. That's not investing, that's torture. Real investing is boring. It's buying something for less than it's worth and then waiting. Sometimes you wait years, sometimes decades. People love to argue about the perfect entry and exit, but the truth is the biggest money is usually made by owning great businesses for a long time and letting them do their work forever. Is not a joke holding period. It's the entire point if you're trying to build real wealth. And this is where the closest thing to magic in finance shows up, compounding. It might be the most powerful force in investing, maybe in all of finance, and almost nobody truly understands it in their bones. I like to think of it like a snowball. You start at the top of a hill with a tiny snowball in your hands, maybe the size of a baseball. You give it a push and it starts rolling. At first, nothing much happens. It's still small. It picks up a little snow, but it's not impressive. Most people look at it and say, this is stupid, I'm going inside. But if you keep it rolling slowly, very slowly, it gets bigger, and then something shifts. It starts picking up so much snow with each rotation that it becomes massive and unstoppable. By the time it reaches the bottom, it's the size of a house. That's compounding. Most people quit when the snowball is still small because they want results now, this quarter, this year. But wealth doesn't work on your emotional schedule. I started investing when I was 11. If I had started at 22, like most people, even with the same returns, I'd have about 60% less money today. Think about that, 60%. Not because I'm smarter, but because I had an extra decade of compounding. Compounding isn't just an abstract concept. It turns modest savings into real fortunes over time. I've seen it in my own life. When I was building Microsoft, we didn't chase quick wins. We focused on long-term growth, letting value compound year after year. It's like planting a seed and watching it become a massive tree, but only if you don't rip it out of the ground every few months to check whether it's growing. Long-term investing also protects you from market fluctuations because the ups and downs smooth out across decades. Most people miss this because they're too busy reacting to daily news or hot tips. People always ask me, what's the secret? And I tell them, it's time. Time is the friend of the wonderful business and the enemy of the mediocre one. Nobody wants to hear that because it doesn't feel like a hack. They want a trick, a shortcut, some special formula. There isn't one. One piece of advice I've shared over the years is to Save like a pessimist, but invest like an optimist. Prepare for the worst in the short term, build cash reserves, avoid unnecessary risks, keep your foundation solid, but bet on the future in the long term because progress is real even when it is slow. From the day I started Microsoft, I insisted on having enough cash to keep the company alive for 12 months, even if revenue fell off a cliff. That's how you survive downturns. But when you invest, you have to believe in progress and human ingenuity, even when the timeline is boring. Now, let's talk about the single biggest wealth destroyer in investing, emotions. The stock market is designed to make you feel things: fear, greed, envy, FOMO, panic, euphoria. And every time you act on a strong emotion, you usually make a bad decision. I remember 2008 clearly. The financial crisis, banks collapsing, headlines screaming disaster, fear everywhere. People were terrified. And I invested in good companies that were suddenly on sale because everyone else was panicking. That sounds simple when you say it after the fact. In the moment, it felt like the world was ending. My phone wouldn't stop ringing. People thought I'd lost my mind. But here's what most people don't understand. When the crowd is terrified, that's often when the best deals appear. When the crowd is euphoric and piling in, that's when risk is hidden and prices get stupid. If everyone is stampeding toward the table, you're probably arriving late and paying too much. If everyone is running away because they're convinced the food is poisoned, sometimes they're wrong, and that's when you can eat for pennies. The hard part is going against the crowd. In 1999, during the dot-com bubble, people looked at fundamentals like they were old-fashioned. Companies with no profits, no sustainable business model, and huge valuations were celebrated. If you refused to join, you got mocked, your short-term performance lagged, people chased whatever was hottest. Then 2000 happened, the bubble burst, trillions of dollars disappeared, and suddenly the people who stayed rational looked smart again. But they didn't get smarter, they just didn't lose their minds when everyone else did. That's the real secret. Not brilliance, but rationality under pressure. And yes, in 2025, we are watching a similar movie with a different cast. AI is incredible. It's the biggest technical advance in my lifetime. But when valuations get driven by hype instead of reality, the ending is usually the same. A few winners change the world, and a lot of investors overpay for dreams that never arrive. That's why mindset matters. If you want to invest in innovation, you have to assume many bets will fail. I poured money into innovation through ventures tied to technology and climate, knowing that plenty of investments will be dead ends. But the point is to back real problem solving, not just chase a narrative. That's why I focus on solutions like clean energy and climate tech. I've committed over $1 billion of my own money to climate tech because the world needs breakthroughs to reduce emissions. It's not about who you don't invest in, it's about who you do invest in, companies that solve real problems. Now, let me tell you why index funds are probably your best bet. I know that sounds strange coming from someone who has spent a lifetime around businesses and markets, but it's true. For most people, for 99% of people, they are better off buying a low-cost S&P 500 index fund and holding it forever. Don't trade, don't try to time it, don't get clever, just buy and wait. Beating the market is hard, not because you're competing against average people, but because you're competing against professionals with teams, data, computing power, and time. Even many professionals can't beat the market consistently. So what chance does the average person have checking their phone on lunch break? Not great. But here's the beautiful thing about an index fund. You don't need to beat the market. You just need to match it. And matching the market for 30 or 40 years with dividends reinvested can make you wealthy. I've recommended that approach inside my own circle. If that plan is good enough for the people closest to me, it's good enough for you. And I'll be honest about the reality of high-risk investing. Even if you're very good, you should assume most high-risk bets won't work. I've always assumed maybe 10% of category-defining technology bets will succeed wildly, and the rest will fail or underperform. That is the math of big innovation. So yes, in a portfolio you can hold steady, boring businesses too, the kind that compound quietly, reliable infrastructure, essential services, durable cash flow. Those aren't flashy, but they tend to survive. For the average person, an index fund gives you that durability without requiring you to pick winners. People always want to hear about mistakes. I've made plenty. There was a company I acquired out of spite because someone tried to cheat me out of 1/8 of a point. That kind of ego can be unbelievably expensive, not always in cash, but in opportunity cost. There was another deal involving a shoe company where I paid with stock. The business went to zero, and the real cost ballooned over time because what you give up can become far more valuable than what you receive. Mistakes are tuition. You will pay it. The question is whether you learn from it. Most people can't admit they're wrong. They double down, they rationalize, they blame the market. But if you can't admit you made a mistake, you keep repeating it. When you make mistakes, don't waste them. Learn, adjust, move on. My biggest regrets are not always the mistakes I made, but the opportunities I missed. The great compounding machines I understood but didn't buy because I was too cautious or too slow. Missing a true compounding monster can cost more than overpaying a little for a good business. Regret is useless if you just stew in it, but it's valuable if it sharpens your judgment. Now, when I see something with real potential, I try to move with less hesitation, not recklessly, but decisively. Now, let's talk about patience, real patience. Most people think they're patient because they held something for 6 months. That is not patience. That is a blink. The real life-changing money tends to come from holding great businesses and great baskets of businesses for decades. Businesses are like trees. You don't plant a tree and dig it up every week to check the roots. You kill it, you plant it, water it, protect it, and let time do the work. Same with investing. Buy quality and wait. Patience also ties into optimism. Progress is slow, but it compounds. And that's true in markets, and it's true in philanthropy and innovation. When we attack large problems like global health or climate, results can take years, but the impact compounds if you stay consistent. Investing in innovation is the same. Some breakthroughs take a long time. You don't get to demand a timeline from reality. People also ask about diversification. How many stocks should you own? If you don't know what you're doing, own a lot, hundreds through an index fund. If you truly know what you're doing, have studied the financials, understand the competitive advantages, can explain the business simply, then you can concentrate more. Diversification is protection against ignorance. Most people are not full-time analysts, and that's fine. That's why index funds exist. They let you be humble and still win. Let me tell you something about money. Real wealth is not about what you spend. It's about what you keep and what you build. I still live in the same house I bought decades ago. People think that's strange, but happiness doesn't come from spending money after a surprisingly modest point. I've known rich people who were miserable and people of modest means who were very happy. The difference usually wasn't the money. It was whether they had internalized the word enough. Once you have enough, more doesn't automatically create happiness. When you can say enough, you become free. And to me, freedom also means giving back. That's why I pledged to give away virtually all my wealth through the Gates Foundation over the next 20 years. We started with around $100 billion given in the first 25 years, and the plan is to do even more. I helped launch the Giving Pledge with others to encourage wealthy people to commit a large portion of their fortunes to charity. It's about impact, saving lives, improving education, solving problems. I won't die rich the way people imagine. Wealth is a tool, not the point. Now, here's another concept. The market is a voting machine in the short term and a weighing machine in the long term. In the short term, prices are driven by stories, popularity, fear, trends. In the long term, prices reflect earnings, cash flow, real value. If you build your life around predicting the crowd, you'll eventually lose. If you focus on weighing businesses and owning the market through an index, you can do extraordinarily well. When you look at businesses, look for protection, what I call a moat, a strong brand, network effects, switching costs, cost advantages, scale. In technology, moats often come from ecosystems, distribution, and deep integration. In other sectors, it's boring, things done exceptionally well, find a wide moat, buy at a fair price, and then let time do the work. And please hear me on this. You cannot time the market. You have to be right twice, getting out and getting back in. Most people sell when they're scared and buy when they feel safe, which means they sell low and buy high. Stay invested. Time in the market beats timing the market. Also, avoid debt as an individual investor. Debt takes away your flexibility. When you're debt-free, you have options. When you're drowning in debt, you have no options. Markets crash and you're forced to sell at the worst moment. Life happens and you're cornered. Debt can destroy you, not because your investments were terrible, but because you ran out of time and choices. Here's the real message. Most people will never beat the market because they're trying to get rich quick when real wealth takes time. They chase excitement when investing rewards boredom. They listen to emotions when success requires rational thinking. But the good news is you don't need to beat the market to be wealthy. You just need to not lose to it. Buy a low-cost index fund, invest regularly, reinvest dividends, live on less than you make, build your emergency buffer, ignore the noise, ignore the hot tips, ignore the once-in-a-lifetime opportunity that shows up every 6 months. Do that for 30 or 40 years, and you will be shocked at what compound interest can do. You may never be the richest person in the world, but you can be financially secure. You can have options. You can have freedom, and that is worth more than winning a scorekeeping contest against people who do this for a living. So if you're watching this, start today, open the account, make the first deposit, automate it, commit to the long game. Your future self will thank you. Good luck.